It's important to understand the purpose of corporate governance and also that corporate governance is different from management. We cannot say that enough. And for us to understand what corporate governance is, it is it is important that we understand what corporate governance really is not. Is that corporate governance is not the same thing as management. When we are talking about management, it deals with aspects of running the organization on daily basis, ensuring that it is well run. Meanwhile, corporate governance is talking about how that organization actually is run. This will be very useful knowledge to corporate strategic management and ethics students of ICANN and also strategic business leaders students in ACCA. So this is going to answer our questions about what the purpose of corporate governance is. So management and corporate governance is different. Corporate governance is not about management activity. It is not about management skill. It's not about management techniques. So the power of the executive management to direct a business is an aspect of governance actually. But how they use that power actually to direct business activity is not part of management. So that is governance. Also, corporate governance is not about formulating business strategy. Don't forget that strategy actually is part of what the owners of the business and the directors should take over and take charge of. So corporate governance is not about formulating business strategy for a company. However, that responsibility of the board of director now, that responsibility of the senior management for directing that strategy is an aspect of governance. So governance is supervisory upon or over management activity, management skill, management techniques. So governance is concerned with something like this. In whose interest is the organization being managed or being governed? So governance deals with independence now. Independence of the directors, and that's one of the reasons we have independent directors to ensure that in whose on whose behalf the organization is being managed is taken care of. There is no undue personal influence or personal interest in whatsoever the management people that have management authority are doing. So supervising the management to ensure management interests are not overtaken by personal interest. That is governance. And it touches on the independence, be it the independence of the manager, be it especially the independence of the directors. Those people are the aim of governance that the owners of business have submitted their authority to direct to. Also, corporate governance is concerned with who has the power to make decision for a company. So who has the power to do what? So that power, that person, that personality must be vetted, and that is governance. So governance is not about the activity or who is doing the activity. The governance is about how, why, asking the question how is being how is it being done? How is it being managed? Why is it being managed the way it's being managed. So who has the power to make a decision? That is an aspect of governance. Also, for what aim or purposes are those powers used? Are they used for selfish interest? Were they used to further the cause of the organization, the corporate objectives, the corporate visions, or self-interest? Corporate governance deals with that. In what manner are those powers used? Corporate governance deals with that. Don't forget that power is the ability to produce results. So it's not only good that we have results, we should have results in a manner that is consistent with our vision, our aim, our objective of the organization, with the stance of the organization. I want to believe we know what stance means now because we are dealt with it. When we are talking about stance, we are talking about what the organization wants to be known for. So in what manner are those powers that were delegated being used? So that's we question our stance and impact our stance. Who else might influence the governance of a company? The corporate governance will definitely see to that. Who might influence a, a director, a manager, a secretary? Who can influence that governance? And you know what? The governance of a company. Whosoever influences, it doesn't really matter whether the person has power, whether the person is known, whether the person is not known, notable or not. If that person has the power to influence, that person is a leader. I want to believe we know that. So, in the eye of corporate governance, that person must be checked and must be vetted. And in reality, many times, people that have influence are not the people that are actually projected. I hope we understand that. There could be a director there that everybody knows as the MD of this organization, but the real influence actually may be a name that we do not know that has real influence. So that person actually is governing the organization. And corporate governance would like to know who that person is. So now are the governors, if we can use that word, of a company held accountable. So accountability is another purpose of corporate governance, to ensure that people at the helm of affairs are actually accountable. They say power corrupts. Absolutely. And absolute power corrupts. Absolutely. So everything should be under check and balances. If not, something will go wrong. So must be accountable for the way in which they use their power and the authority that has been given unto them. Another purpose of corporate governance is to ensure how we manage risk. How are we managing risk? Risk management is very important and heartbeat of corporate governance. How are we managing our business exposure? Don't forget, when we're talking about risk now for an organization, we have an inherent risk. Those are the risks that we can't do without because we are in that industry. Let's say, for example, we're the industry, petroleum industry, and we are selling, let's say, kerosene. That is that fuel that they use to for cook to to cook, as again using cooking gas and the like. Anybody that sells that should expect spillage. So it's an inherent risk in that industry. So how are we managing it? So now that it is inherent, does not mean it should be excessive. So it becomes abnormal loss. Normal loss turns to abnormal loss. So governance want to know how risks are being managed and who is managing risk, how the risks are being managed. Also, corporate governance concerns itself with fairness. Fairness. equity. Now we are not talking about equality, we are talking about equity. Equity, that is, everything should be done in fairness. In fairness. So, are the administration of the organization being fair, or the administrators of the organization, are they being fair? Is there equity in business dealing? That is what corporate governance is all about. Openness, transparency. Are we open to criticism? Are the directors, are the managers open to criticism? If they are not open to criticism, we said that the corporate governance, the body language of managers are not favorable to corporate governance. There should be openness, there should be accountability. Honesty and integrity, which usually we call probity, is another purpose for which corporate governance must exist. Don't forget, in every country, there is an institution, agency of government that has the responsibility for corporate governance actually. An aspect of that agency, we touch strongly on that, the Federal Reporting Council of Nigeria. They own the corporate governance as part of their core. So probity is another focus of corporate governance. Honesty, how honest are the managers, the integrity of the business, the integrity of the people, the personality behind it. These are concerns of corporate governance, like the Cadbury report of 1992 defined what corporate governance is. That's a system by which a company or companies are directed and controlled. So management is about making business decisions, but corporate governance is a system by which companies are directed and controlled, that is monitored. So the term corporate governance actually means monitoring, controlling decisions, as well as giving leadership and direction. And you know, when we are talking about leadership, it's about example, exemplary leadership. So if management is about running the business according to Professor Bob Tricker, then governance is about seeing that it is run properly. Let me come again. Professor Bob Tricker actually said in 1984 that if management is about running business, running activity of the business, then governance is about seeing or ensuring that it is actually run properly. The business is actually being run properly. So we must not confuse corporate governance with management, or management purposes with governance purposes. Now we are dealing with governance purposes. And we've mentioned fairness, we've mentioned openness and transparency, had discussed independence, had discussed probity, that is honesty and integrity, accountability among many other things we've discussed. When we are talking about corporate governance, actually it's more complicated when we are talking about sole proprietorship, but it's a bit at ease when corporate governance is about large organization, large incorporation, because problems arising from the separation of power and control takes a toll, or take a toll rather, on sole proprietorship, one-man business, than big multinationals and large incorporation, because there is delegation of power, there is separation of power and control. But for sole proprietorship, the power to control, the power to oversee, the power of ownership also lies within the same person. So corporate governance is a bit difficult. So that means there's less of fairness, there's less of openness, there's there's less of accountability, there's less of independence, and we ask ourselves, who is a sole proprietorship, a sole proprietor actually accountable to himself, or herself? So because of that, we cannot be talking much about corporate governance when we are talking about sole proprietorship, woman business, and the like. So like I said, every country has code of corporate governance set by the agency of government to champion corporate governance in the land. Let's look at some aspects, main areas covered by code of corporate governance. Then we'll be talking about the composition and the balance of the board of directors. We need to touch on the role and the responsibility of the board of directors. Financial reporting also is very important, both in narrative and the auditing aspects of financials and financial reporting. Directors' remuneration, we must talk about it. It's part of code of conduct, code of corporate governance rather, that almost every organization must comply with. The risk management, the internal control, the shareholders' rights. So I'm going to take them one after the other, not actually in any particular order. Shareholders' rights is very critical and at the heart of corporate governance. Don't forget, in sole proprietorship, the shareholder actually is the driver of the business too. So he or she can maintain and oversee and defend his or her rights in business. But when the organization is large, multinationals, incorporations, is a bit difficult, and majority of the time the shareholders are not the executives that are actually running the business. So therefore, the code of corporate governance and the agency of government to monitor that must ensure that shareholders' rights are protected. The right to receive dividend, the right to ensure that their monies are not squandered or the organization not well managed in the interest, first of all, of the shareholders and also of the general public. And don't forget, government is not just working too, they are working also to take their cut. Okay, so then risk management also is part of the code of corporate governance, because if risks are not well managed, the organization will go down. So this is another area of code of corporate governance. And for risk to be well managed, there must be strong internal control system at work. So the directors should ensure that their companies operates within acceptable level of risk, and should also ensure through a system of internal control that the resources of the company are properly used and the assets are protected. Because if the assets are not protected, what would the organization run with? Resources are not protected. So corporate code of corporate governance will see to that. Directors' remuneration too, as agents of government now, as agents of shareholders rather, under agency theory. The shareholders are now available to run the organization. They put the directors in charge. So it's important how directors' remunerations are set to forestall crisis, so that personal interest will not take over. So directors work for a reward. We agree as to that. So to encourage their commitment, now especially when they are not business owners or have maybe share options in which they buy part of the organization's share, and have the sense of ownership. Their remuneration must be rewarding, if I can use a word like that, to ensure that they are committed to the objective of the organization. So they should be given suitable incentive. We can link their incentive or remuneration to performance, of course. The better they do, the better for the organization, the better for themselves. So the remuneration structure must be a bit flexible and robust too, to ensure that they are they align with the corporate vision. Financial reporting is another aspect of code of corporate governance, and it's important that financials are independently audited, and government want to see to that organizations submit their audited reports. This is to ensure that fraud scandals are minimized, may not be totally eradicated, but are minimized. Another aspect of corporate governance code that we must look at is the composition of the board, and ensuring that there's a balance in the board of director. The balance should come in form of knowledge base, diversified knowledge base, experience, exposure, even to age. Like too young people, too much young people on the board may not be too good for an organization, and too much old people too on the board may not be too good for the organization. So we need both the experience of the old and the energy of the young and the optimism of the young to make a balance. Also, when it comes to the side of the gender, we need both male and female, not that the composition is all male or is all female. So there should be balance, and this is another critical aspect of code of corporate governance. The last one, but not the least, I'm going to mention before we round up so that this video will not be too long, is the role and the responsibility of the board of directors. It must be well spelled out. It must be well spelled out. Governance is therefore concerned with the establishing what the responsibility of the board of directors should be. They must ensure and make sure that things are done properly and carried out. So we need to know our rights, we need to know our responsibilities, we need to know our rewards as members of the board of directors for things to go well. Having known all this, as I begin to summarize and round up, what is a good company to you? What yardstick are you going to use to say an organization is a good company or is a bad company? Don't forget that our morality, our perspective of ethics are actually different. And for you to answer that question, invariably, you are giving us your side of ethics. So we would like to know, especially those that have been following us as we dealt with ethical aspects of things. My name is Benga Olatunji FCA, and Gigens Associate is the channel. We had love because of the algorithm of YouTube that you subscribe and you click and you share. These are simple things you can easily do for us in 5 steps. Like, comment, share the video, subscribe, and click the notification, click all. So simple, right? And you can be sure to receive value. You received some value so far. So why won't you think of liking the video, and subscribing. So the summary of everything we've said is the purpose of corporate governance is about ensuring fairness, overseeing the management activity, not about running the organization, but ensuring that it is well run properly, ensuring transparency, ensuring openness, independence is important, honesty, integrity, probity to sum it all, and accountability. From G. James Associate China, Bengal Latinji FCA, we have value to life, we have value to your businesses.